and we achieved significant milestones across all of our businesses, One India, North America, One Africa, and EMU. In India, we crossed a significant threshold with the business surpassing 12,500 crores in revenues, underscoring the strength and resilience of our domestic franchise, which is our largest franchise. In North America, the successful generic Ventolin approval from our US facility marked an important strategic inflection point and reinforced our R&D capabilities. Our One Africa business continued to deliver market-beating growth, and our EMU operations scaled meaningfully to become a 400 million plus business unit. Together, these achievements highlight our disciplined execution and our commitment to sustainable as well as diversified growth across geographies. Now, let me touch upon the individual businesses. Our One India business delivered a robust performance this quarter, growing at 15% year-on-year, driven by strong double-digit growth across branded prescription, trade generics, as well as consumer health. Full-year growth stands at 9% YOY. On the branded prescription business, our key chronic therapies, respiratory, anti-diabetes, cardiac, and urology delivered a strong double-digit market growth. Our chronic mix stands at 60% as per IQVIA MAT March 26. Foracort, our leading inhalation brand, surpassed the revenue of 1,000 crores, reaffirming its position as a respiratory market leader. Meanwhile, Diator, our cardiac brand, has established itself as a 650 crore brand, delivering 25% YOY growth. This year, we expanded our presence in the IPM by adding 4 brands with revenues exceeding 100 crores, bringing the total to 33 such brands. And our footprint in the top 300 brands in the industry now has 23 such brands. This year, our growth has also been helped by a series of successful differentiated product launches across the core therapies. In respiratory, we launched products into the inhalation franchise, including Foracort G Synchrobreeze, Cipla, and the triple combination Voltido Trio, which are strengthening adherence while delivering therapeutic benefits. In antimicrobial resistance, we launched Remdri, Cipenmed, Esplosip, which underlines our presence and leadership in resistant and critical infections and AMR. In urology, we launched a novel product called Stricter, which expands our leadership in non-antibiotic management of recurrent UTIs. In our diabetes franchise, we launched SGLT2-led portfolio, including empagliflozin. And in dermatology, we launched an innovative solution, Perfecta, for scar management. Together, these launches reflect our execution strength. It reflects our focus on complexity and our commitment to driving sustainable growth through improved patient outcomes. During the year, we also enhanced our pipeline and portfolio through strategic partnerships. We entered into a collaboration with Eli Lilly for Yurpeak, making our entry into the fast-growing obesity segment with best-in-class molecules. Our partnership with Mankind Corporation of US brought Afrezza, India's first rapid-acting inhaled insulin, reinforcing our focus on differentiated diabetes solutions. And we also gained exclusive rights to Pfizer's key established brands, further strengthening our access to strong brands in the IPM. Additionally, the acquisition of Inspira Healthcare enhanced our portfolio on pediatric and wellness product sides. Put together, these efforts meaningfully enhance our portfolio and reinforce Cipla's long-term growth ambitions. On trade generic side, we continued the strong growth momentum, delivering double-digit growth YOY for the quarter as well as for FY26. This performance was driven by a focused execution across distribution, a robust pipeline of strategic new product launches, and meaningful advancements in technology-enabled operations. We will continue to expand portfolio and use that as a key driver for growth, with 70 new launches planned this year. Our consumer health business continued its strong upward growth trajectory, with Nicotex, Omnigel, and Cipladine consolidating their number one positions in their respective segments. The business is driving very healthy secondary growth and actively exploring opportunities to invest in products and channels to further expand our distribution network. Operating profitability has improved in CHL, reflecting reflecting the strength and scalability of our consumer health strategy. Coming to North America, the business reported quarterly revenue of $155 million and an annual revenue of $780 million, supported by demand in our differentiated portfolio and a steady base business. Albuterol market share increased to 19.6% as per IQVIA MAT March 26. During the year, we advanced our portfolio with several key assets including liraglutide, nintedanib and dapagliflozin. Notably, we received regulatory approval for the first AB-rated generic Ventolin with CGT, representing the first commercial MDI product to be manufactured from our US facility. This milestone reinforces our growing confidence and capability to deliver complex generics, not just from India, but also from our US manufacturing facility. We are expecting to launch this product within the coming months. Our Goa facility, together with two US facilities, is well equipped to support the launch of all four respiratory assets planned for FY27, enabling a seamless and well-coordinated supply to the market. Our One Africa business grew at an impressive 14% year-on-year growth rate during the quarter, with a full-year growth of 7% YOY in USD terms, powered by firm performance across key markets. In the private market, our secondary growth outpaced the market growth with 6.6% versus 4.8% for the market. In EMU, our focus strategy on deep penetration has built a strong foundation, enabling the business to reach the $400 million US revenue mark. This is despite the significant volatility that has been happening in the recent months because of the war. The business remained resilient during the quarter, navigating geopolitical uncertainty and disruptions with strength and discipline. It was led both by DTM and B2B categories alongside consistent margin stability and internal pipeline assets. On the regulatory front, during the year, US FDA conducted and concluded inspections at 3 of our manufacturing facilities in India, Bomasundra in Bangalore, Scitech at Mumbai, and Medispray in Goa. All of these inspections resulting in a VAI or NAI classification. This accomplishment reflects our sturdy dedication to quality, compliance, and operational excellence. A quick update on our US pipeline. We continue to prioritize organic investments with sustained focus on advancing R&D capabilities for the US market in particular. We remain very confident in our US business outlook, which is supported by a pipeline of nearly 40 to 50 products to be filed over the next 3 years. And this includes 12 first to file and 8 B2 opportunities that they are targeting. In the respiratory portfolio, 5 assets have been filed, including the generic Ventolin. 4 of these are expected to be commercialized in FY27. We are also going to deepen this pipeline with 4 additional respiratory assets scheduled for filing over the next 24 months. Importantly, we remain committed to sustainability and innovation, with 2 respiratory assets incorporating green propellants expected to be filed over the next 24 months as well. In peptides and complex generics, 8 assets are already filed, with select launches projected between FY27 and 28. We aim to file 3 more peptides and complex generic assets in the next 12 to 24 months. Additionally, we are working on oligonucleotides, and we are also having 2 global biosimilar assets. One is undergoing clinical study under an IND, and the other is in earlier stage of development. We see biosimilars as a very large and under-penetrated opportunity, and with the recent change in some of the guidelines, we believe this to be an upcoming almost $200 billion opportunity, with around 100 such biologics expected to lose exclusivity over the next decade. So we are going to enhance our efforts on biosimilars. We have a JV with Camwell, which is focused on execution, which has an initial pipeline of respiratory assets and oncology assets. We are looking at adding at least 1 to 2 assets on in-house biosimilar development through this JV, which will which will really build our presence in the biosimilar space over the next 5 to 7 years. On the back of these ambitions and with a very solid foundation of execution, we are also accelerating our AI-led transformation. Our strength has always been on execution across quality, manufacturing, and regulatory. And with the AI transformation, we aim to become a leading AI-led pharma organization. We have invested in robust data and technology foundations, which allows us to scale this up in a structured and sustainable way, and also in a very timely fashion. So we will be focusing a lot on driving efficiency, productivity, and better decision making with the help of AI over the coming coming years. I would now like to invite Ashish to present the financial and operational performance.
Thank you, Achin. I'd like to present the key financial highlights for the quarter and the financial year. So we reported a quarterly revenue of 6,541 crore, and as a result of that, we ended the year with 28,163 crore. The EBITDA margins for the quarter stood at 15.2% and 21% for the year. And like every time, this does not include other income. The gross margin after material costs stood at 65.6% for the quarter and 66% for the full year. And this was primarily driven by the product mix in the revenue. Total expenses for the quarter include the employee cost and other expenses, which stood at 3,296 crore. This was higher by about 10% YOY. Annually, the expense were 12,689 crore, which was again a similar percentage increase YOY. The increase in employee costs reflects a planned investment in talent, both to support our markets as well as to strengthen our manufacturing readiness in both India as well as in the US. Overall, the operating expenses also include continued investment in R&D, which stood at 509 crore, which is at about 7.8% of the revenue for the quarter. And for the year, it was 1,974 crore, which is at about 7% of the revenue. These investments are aligned with our pipeline priorities. It enables our new launches and it builds readiness for the upcoming products. As a result, we are scaling up our annual filings like it has been highlighted by Achin. In addition, we have started to see some impact of ongoing geopolitical situation within the operating expenses, which we are closely monitoring. In the near quarters, we don't see much a meaningful impact, but in the future quarters, as the revenue inventory gets consumed, you'll see that impact coming through. For the quarter, PAT stood at 555 crore, representing 8.5% of sales, with an effective tax rate of 22.2%. On the full year basis, the PAT amounts to 3,879 crore, accounting to 13.8% of sales, while the ETR for the year is 25.9%. Our ROIC stood at 22.9% for the year. And of course, PAT also assumes a certain impairment that we've had during this quarter. Our free cash flow generation and operating efficiency endures to drive healthy net cash position. As of 31st March 2026, the debt on our balance sheet, including the lease liabilities, stood at 614 crore, with net cash equivalent balance at 10,526 crore. Looking ahead, the key priorities will include, for One India, it would be to focus on execution to sustain the growth momentum and to outperform the market in branded generic, trade generic, as well as in consumer wellness. We will further strengthen our presence in chronic therapies, including diabetes, cardiology, urology, and dermatology, while maintaining the robust trajectory that we've built in respiratory. In North America, we will concentrate on enhancing our commercial execution and accelerating new product introductions. And our aim is to cross $1 billion mark as a run rate towards the end of this financial year, i.e. FY27. In South Africa, our focus will be on improving the private mix with correction in tender contribution. In EU, our top priority is to drive top-line growth by deepening penetration in core markets while maintaining a strong margin trajectory. Looking ahead to FY27, supported by a ramp-up of new launches and investments that we've made across our manufacturing facilities and ongoing expense optimization initiatives, we expect the EBITDA margins to be in the range of 18.5% to 20%. And this would be actually achieved with a sequential improvement quarter on quarter, with the key improvement being in the second half of the year. And on an overall basis, you'll have 18.5 to 20% kind of a range. And this guidance does not include any contribution from Lanreotide in FY27. I'd like to thank you for your attention and will revert back to the moderator to open up for the questions and answers.
So should we open the floor for questions?
Yeah, sure, please.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and then 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Your first question comes from the line of Vishal Manchanda from Systematics. Please go ahead.
Hi, good evening, and thanks for the opportunity. During the quarter, did we kind of book any shelf stock adjustment for Revlimid?
No, I think we had shared this in the last quarter as well. We did not have any SSA adjustment.
Okay. And second, on generic Ventolin launch that you are expected to do next month. So just wanted to understand if the innovator is supposed to launch a green version of Ventolin sometime by third quarter of this financial year. So hypothetically, if the innovator is able to replace all of their Ventolin product with the new version, would that impact Cipla?
Right now, generic to the existing Ventolin. The switching to another variant is, I think that will be a process, which is not an automatic process under the US law at this point of time. So we do not anticipate any near-term impact of that change as and when the transition starts to happen.
Okay. And if you could update on the respiratory pipeline, the key assets, Advair, Symbicort, QR, Flovent.
So I think as we had guided, we were expecting 4 approvals this year. Ventolin has already got approved. We are, having different goal dates for different products. So during the year, we are expecting, Advair, Symbicort, and then one other asset to get approved. So this will happen during, I think, H1 and one is H2 as well.
Okay. And what is holding back Advair for so long?
I think your question is probably more historic. If you recall, we had OAI at our Indore facility, so we had to tech transfer to the US, which caused the delay. But now we're ready with everything. So it's just a matter of receiving the approval.
And just one final one. Right, sorry.
Sorry, just to complete, we went through a pre-approval inspection on our US facility for this particular product.
Got it. And just one final one, do you expect to see any benefit out of the EU FTA for your respiratory portfolio, because you source a lot of the basic devices from Europe?
At this point, we're not expecting any meaningful impact of that. I think it's more business as usual at this point in time.
Is there a change in the duty structure there, or it remains the same pre and post EU FTA?
It remains the same, so there is no benefit as such. And in EU, we are already selling respiratory devices which are in-house. So, there's no significant benefit that we see coming from EU FTA.
My question was more from a sourcing standpoint, like the key raw materials that come from Europe. Would they be cheaper for you?
No, so we get some raw materials from there, especially on the devices side, but there's no any such benefit that we have out there.
Okay. Thank you.
Thank you. Your next question comes from the line of Siddharth Nigandhi from CWC. Please go ahead.
Hi, thanks for the opportunity. Just wanted to understand the specific initiatives around AI which you mentioned. If you could share any specific initiatives that you've taken and any other pilot initiatives that you see scaling up in future.
Yeah, so AI is a broad-based implementation that we're targeting, which will focus across multiple functions. And the difference between what used to happen in the past versus now is we're focusing on end-to-end processes versus small, limited use cases. So this will be, we have implementations across quality, regulatory, corporate functions, and a lot of the R&D related use cases as well. So the idea is to use it in a way that helps obviously faster and better decision making, but also ultimately gives us productivity benefits.
Right. And on the biosimilars front, just want to understand in terms of your strategy for biosimilars, are you looking at in-licensing or are you looking at your own development, and what sort of a pipeline and timeline are you looking at for that, both from a US and EU perspective? And is that sort of accelerated given the new FDA draft guidelines?
Yes. So we have predominantly an in-house strategy where we have two assets currently under development for developed markets. One of them is already under clinical trials under an IND of US. We will be adding 1 to 2 assets each year, which will then therefore start resulting into a pipeline of 6 to 8 in-house assets over the next 5 to 8 years. On top of that, we are considering a limited amount of in-licensing where there are near-term opportunities that are not within our in-house portfolio. So for those, we are open to considering some in-licensing opportunities as well. But we see this as a newer space, more so because of the changes to the guidelines, which have placed us in a good position where we can run these like the other complex projects, and we can benefit from the overall economics of developing these projects.
Just fine. Thank you so much.
Thank you. The next question comes from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah, thank you for this opportunity, sir. My first question is on the US revenue guidance, what you are talking about. about $1 billion by the end of this year. So, also simultaneously, you have mentioned that in your guidance for 27, you have not factored lanreotide. So that means in your expectation for FY26, you are not considering lanreotide, and obviously this lenalidomide is not there. So if we kind of deduct these two product revenue from the $780 million annualized revenue of FY26 for US, so the number what you're talking about is almost like double the size of this US business of FY26. So what is the kind of bridge that we are talking about? Where from this revenue build-up that will happen? Can you give some clarity, sir?
The guidance, I just wanted to clarify, is $1 billion run rate by the end of the year. We are not guiding for $1 billion revenue during the year, right? The reason for that is because a lot of this is contingent on pipeline maturing. So we have one approval already in hand. As we mentioned, there are 3 other respiratory approvals. There's one big peptide approval, and there are 3 other products which have already got approved in the year, smaller assets, etc. So as these products get approved, our run rate will keep improving, and we will get to that $1 billion by the end of FY27, which puts us in a very good position because what historically, we were shy of that. We would want to see the year ending at a good run rate of $1 billion in the US.
Okay. So that means kind of in the second half, we will see a run rate of almost like $100 million incremental revenue versus the quarterly run rate in the first half.
Yeah.
Okay. And now, is it fair? Means since you have mentioned that lanreotide you have not factored while guiding for the margin for the year. So is it? So what is the outlook that we are giving for lanreotide for this year and for the subsequent period, given the kind of total disruption that we are currently seeing for that molecule?
So for lanreotide, we have the partner who's working on the remediation efforts. That's in full swing, and we are helping them as much as possible on navigating that path. So I think maybe by next quarter we'll have closer visibility on their exact remediation timeline, which will also include a reinspection from the FDA, so that we can come back and guide after a quarter. But in parallel, we have also identified alternate supplier for this, alternate manufacturing site, which will be based out of the US. So the objective is to be able to file by early next calendar year, also Q4 of this financial year. That gives us a two-pronged approach to overcome this. So I think it will come back. It's a very interesting opportunity, being a long-acting injectable, and once we are able to resolve either of these two, and now we have 2 shots at goal, we will be back in this. Definitely from an FY28 perspective, it will be new.
Sure, sir. Sir, on Ventolin, that is the next question. So when means we already mentioned that we have around 22% kind of or more than 20% kind of market share in the albuterol market itself in the US. So now with another variant of albuterol is getting approved, do you find any changes to the kind of market dynamic in terms of the pricing or in terms of the competition or in terms of your scope in albuterol as a whole, whether it will lead to incremental business or not, since it is a variant of albuterol only, and the prescription would be based on albuterol HFA that way?
Yeah. No, these are different products because they get substituted to the different innovator products. So it's a different NDC, different market, and we have CGT on the generic Ventolin, so we will actually be exclusive, for a 6-month period. And we expect a significant uptake. There is no cannibalization that will happen on the other variant, which is a generic to, another variant of same molecule.
So we're more likely to take the share from the existing Ventolin suppliers rather than going to each from the other franchise.
Okay. Just last one question from my side, sir. Is there any scope of rationalization of the cost on the cost front? See, because if the revenue is likely to slide on the US front particularly, so are we likely to see any reduction in any cost line item for FY27?
So look, there are two parts. Working on number of productivity enhancement measures which will help us optimize the cost, including some of the tech-related transformation that we spoke about. But the short term, there are disruptions because of the war situation on sourcing side. So right now we're having visibility to what we've seen so far, but if it prolongs, that's something that is that's some still yet to be quantified. But to answer your question on basic efficiencies and productivity, yes, we're working on that, and it will materialize as we go through during the year. There's one more point which I think you should keep in mind is we had invested in our North America facilities for these complex products, and so far the cost has been there in the last quarter or two, but the revenues have not commensurately come. So we will see that corresponding revenue with the new launches. And therefore, the economies of scale will improve as we go along.
Sure, sir. Yeah. Thank you. Wish you all the best.
Thank you. Your next question comes from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. So just on the R&D, connecting R&D spend, overall almost 2,000 crores, but at the same time, very few ANDAs being filed. So is it that the R&D spend per ANDA is significantly higher, maybe for FY26, 25 compared to the earlier, let's say the philosophy of R&D spend per ANDA? That's my first question.
Yes, actually, we have gone up products, including some first to files, which are on oligonucleotide side as well. So we've gone into more respiratory, more peptide, and more oligo, which is resulting in higher spend per filing.
And some of these also involve litigation cost as well. So that also leads to higher R&D spend, which has got everything in that R&D spend that you see, both API cost, your R&Ds that you buy, litigation, etc., etc. And of course, some of these oligonucleotides, etc., we go outside to CRO, CMOs as well. So there is also cost involved in that.
So typically, at least without getting into product-specific details, but let's say for respiratory and oligo products, like per ANDA R&D spend, broad number you would like to call out?
I think that's very case specific, so it's difficult to call out an average number. We are guiding towards 7%-ish on R&D spend as a percentage of sales, and we're also going to, I think in the mix, the mix will also change slightly in the coming year because, as I said, 40 to 50 filings with respiratory, with first to files, and certain number of peptides, etc. So hard to put a metric on per filing because the nature of that filing changes a little bit. But our endeavor is to go after complex opportunities which keeps the business sustainable, and NPV per project has to be high. Right? That's the internal criteria.
Got it, sir. And secondly, the albuterol market share has sort of reduced quarter-over-quarter, while the number was at 19.5, then it moved up to 22, and we are now back to 19.5. Anything to read through in that?
No, I think it's hardly a reduction that you see out there of 0.4% or so that we've seen. So I think 19 to 20, or rather 19.5 to 20 is something that you should pencil in. We are ranked 1 out there, and if supply was, if you could supply more, then we could, there's a potential to increase the share as well.
And just to complete on that, the R&D part, is this Indore site regulatory issue also one of the reasons for, let's say, is it delay in filing because of the regulatory issue at Indore site, or the Indore site classification has got nothing to do with the filing of the assets?
No, so now we've de-risked out of Indore, so our assets are filed from US, and one of the assets we are doing from Goa because Goa is cleared.
No, I was referring to, let's say, prospective filing, not the ones which are already filed. Let's say where we do R&D spend, where the product probably from a validation or exhibit batches are ready, but because of classification at Indore site, the acceptance of filing by US FDA, is there that kind of a delay also happening?
Same, likewise for potential filings also, we are focusing more on Goa and US side. And Indore, I think we will accelerate as soon as it clears. Yeah.
Got it, sir. And just lastly on Ventolin, this product will see a gradual pickup in terms of market share. Like what's your strategy, if you could highlight, given while we have exclusivity, but will the pickup be gradual enough, or we can have a sizable business in, say, 2 to 3 quarters timeline?
Yeah, so you will see towards second half a ramp up happening in generic Ventolin. Though we will launch it within the quarter one, yeah, but the ramp up will happen in half 2.
And capacity won't be the constraint for this product?
No, we have US facility for it.
From the device combination as well, perspective.
From which, sorry, come again?
From the drug device, while drug would be there from...
Not a problem at all on the devices side.
Got it, sir. Thanks a lot, sir. Thanks a lot, sir. Thanks a lot, sir. Thanks.
Thank you. The next question comes from the line of Damayanti Kerai with HSBC. Please go ahead.
Hi, thank you for the opportunity. My question is again on your US exit guidance of $1 billion in FY27. So you indicated a couple of interesting products in respiratory, peptides, etc., which can help you to achieve this rate. So my 2 questions there. What kind of visibility you have on these products, which gives you confidence that you can receive approval in this year? And second is, for some of the bigger assets, what kind of risk mitigation strategies which you have already implemented? So if you can elaborate on these 2 points. Thank you.
No, so see, I think it's in terms of confidence in each of these assets, we are seeing some developments happening. Like for example, in Advair, now you've had a PAI that has happened. Okay, Ventolin, where we were expecting around the same time, we've got the approval. In certain other assets also, there is an ongoing, discussion readiness that is there. Of course, we can't anticipate when the approval will come through, but in some of them we are aware of the goal date, etc. It us well for quarter 3, quarter 4, wrap up to happen to $1 billion kind of a run rate. And that's what we have envisaged in our business plan. And from facility point of view, all these facilities are also needed. So from internally, it's only pending approval. From internally, we are ready to, kind of launch these assets as soon as the approval comes.
Sure. So when you say facilities issues are de-risked, so most of these filings are filed from two sites, say one from India and one from US. Is that the case?
No, that won't be the case. Right now, these are filed from US or from Goa. You will have 1 or 2 assets filed, but and these are respiratories that I'm talking about. The peptide is with a partner site outside. So we don't anticipate any. That's why I'm suggesting that we don't anticipate any risks in the facility. Goa has recently got inspected as well. There are 2 observations. We are waiting. We have responded to those observations. We are waiting for the classification. Can't comment on that. But nevertheless, that's the status of our facilities.
Sure. My second question is on your India business. So obviously, fourth quarter, I believe, is very strong. And full year, you ended at 9% growth for the segment. So when we look ahead, say 27, 28, do you think you can outpace IPM growth in, say, next 1 or 2 years, or it might take slightly longer? Because, say, market growth also improved in recent time. We are seeing around low double-digit growth for market. So on that perspective, you are just like close by, but not outpacing the market as of now.
Yeah, so we are confident that we'll be able to deliver a strong double-digit growth as well as a market-beating growth in FY27, 28. And we've been seeing that consistent trend over the last couple of quarters.
So, okay, so you think it's possible. Okay. And my last question is on your gross margin trends. If qualitatively you can give some color, given now your product pipeline is becoming more complex, generics heavy. So in that sense, how should we look at your gross margins in, say, near term or in medium term?
Yeah, see, it's a large mixed bag in the gross margin. So there are many factors that go into it. So like in the last quarter, I had highlighted that we had, R&D costs, material costs going up, due to which the gross margin had got impacted. So some bit of that has got reversed in this quarter, where the margin is better because also, not just the product mix, but also because the R&D material cost was lower in comparison to the previous quarter that you saw. I think the way I look at it is that, of course, lenalidomide was a high margin stock, but most of our respi assets that are coming are mostly in-house products. So in-house products will always give you a higher end of the margin, more than the company average that you're seeing today. So it will only accrete to your company gross margin. But at the same time, some of the peptides that we're talking about, and oligo is much later, but peptides that we're talking about, they are partnered products. So while the gross margin could be high out there, but there is also a profit share as a royalty that we end up paying, which goes into gross to net. So therefore, your gross margin in those products will be after the profit share, which kind of brings it down. But at the same time, the S&D, etc., in the US at least is not much, so it is accretive significantly to your EBITDA margin. In India, we are moving more and more towards chronic. So chronic will definitely come with a 5 to 10% better gross margin. And we are keeping a very tight control on what ILDs we do. So keeping all these things in mind, I think gross margin should have a positive bias. And the last thing that I just want to highlight is that generally you will see in the result also there are strong controls that we have over costs. So every year we take some target to actually reduce the cost such that it is lesser than the revenue growth that you see out there. So I think these are the things that we take care of. Of course, there is this whole geopolitical and war risk that is there. We had some impact of that in quarter 4. We have some impact in quarter 1. Not significant though, but some of these inventories that we're buying today, as it gets consumed in second half, there may be some costs, but that's temporary. Like I think your question was more around longer term sustainable. Longer term I've talked about, but there may be some blips here and there because of the reason that I mentioned.
Sure. Thank you. Thank you very much for your response. All the best.
Thank you. Our next question comes from the line of Nikhil Mathur with HDFC Mutual Funds. Please go ahead.
Hi, good afternoon. I'm sorry to be hopping on the US guidance. One clarification, when you were saying that you will be at $1 billion exit run rate, does it include Lanreotide or it doesn't include any contribution from Lanreotide?
So at the moment, we've left that out of this guidance, so that will be an upside to plan if we can successfully, get back in the market before that.
Okay. So if I analyze this quarter's US revenue, you are at around $620 million. We are talking about $1 billion exit. So this is about $380 million of incremental revenue. Just want to understand the skewness of this $380 million. So there are, I think, 6-7 products that you are launching this year. What kind of contribution will be from 1 or 2 products in this incremental revenue? Will it be a skew towards 1 or 2 products, or can there be an equitable distribution among 6-7 products? Because I'm just asking so that it doesn't create a big risk in FY28, because if competition comes in, then again you kind of face a situation which you face in Revlimid this year.
So, Nikhil, in terms of annualized revenues from these products, I think a couple of them we are expecting 100 million plus annualized opportunities, right? And the others were also significant, right? So, and then this is respiratory, and then there's a peptide asset which is also big. So we are expecting big contributions. I think the reason we're not able to give a quarter-wise kind of breakup or a product-wise breakup is because the timing of launch, if it moves 1 or 2 months, that affects the full year number. But run rate-wise, assuming we have these launches, we will be able to cross that run rate by the end of the year. So there are, 2-3 big opportunities and a couple of medium-sized opportunities.
Got it. And what kind of a tail are we looking at in these plus 100 million opportunities? I mean, can they continue for, let's say, a couple of years, 28 and 29, or in 28 onwards only we can see some bit of erosion starting to happen?
So, see, these are not like the 6-month exclusivity kind of opportunities. So, even if competition enters, they will taper off slowly, right? So they are more like, the way to look at it is what you saw on our albuterol or what you saw on our Lanreotide prior to supply disruption issues. These are more steady opportunities. So where we have to manage some level of price erosion, but not a cliff kind of scenario, right? So these are steady opportunities.
And if there is a price erosion with new competition coming in, you may see some volume going up. So you'll have to manage it as a dollar value rather than looking at it as volume or a price gain.
Understood. On the India business, can you quantify the contribution from your peak in 4Q? I imagine it's only 4Q where your peak would have contributed, not in 3Q, right?
Yeah, it wasn't that large because, real sales started happening in Jan. So Jan, Feb, March, we've seen growth internally in secondaries. April also we saw an improvement over March on secondaries. But yeah, and it's not out of the 15% overall One India we've reported, it's not going to be a meaningful percentage.
Sub 1%? Is that the sub 1 or sub 2%? Is that how we should read it?
I think those figures are broadly available in the market. If you look at IQVIA, I'll give you a direction of how much primary we are doing.
Okay. And is there any M&A component or in-licensing component that I might have missed, which is also leading to this double-digit growth in 4Q?
Yes, we had in-licensing of some Pfizer products. We had a small acquisition of a business called Inspira.
Okay.
So, the base will still be double digits.
I think the presentation also we had mentioned, I think the 4 or last time on. We've always announced these 3-4 ILDs and acquisitions that we've made.
Okay, understood. Thank you so much.
Thank you. Our next question comes from the line of Saion Mukherjee with Nomura. Please go ahead.
Yeah, hi. Thanks for taking my question. Ajin, over the next, let's say 2-3 years, how should we think about, your capital deployment, both, let's say, organically or inorganically? If you can give any color, the kind of assets and capabilities that you're looking at.
Yeah. So, look, I think we are preparing for a solid growth over the next, 5 years and beyond. And for that, I think the number one deployment is going to be on R&D side. So, we have plans to accelerate R&D pipeline. So, respiratory assets we have come under approval for which we are filing. Complex products which we outlined was peptides, other differentiated products. But also we're going to step up on biosimilar side, where we would want to do, roughly 6 to 8 internally, and if we find a couple of good opportunities, we can supplement through inorganic as well. So that will consume some capital. Then we have capex, which we have increased steadily over the last 3 years. So this cycle will probably reduce after another year or so because we've built enough capacity for the products that we want to supply, and beyond that we will be led more by productivity initiatives. On top of that, inorganic, we are interested in looking at assets. We evaluate several assets. Our bias is more towards differentiated specialty kind of products for developed markets, which is US and Europe, which give us a more sustainable growth and some capabilities as well. So I think those are the areas where we would want to deploy capital in order to sustain the entire trajectory over a longer period of time.
Yeah, anything in India or emerging markets, like more in branded generic space, you think Cipla would be looking at, or this would be largely organically built?
So, India, we've actually put a slide in the investor deck on the partnerships we've done. Acquisition, a large acquisition in India is, little difficult for us because we are a number 2, number 3 player. We're actually number 1 by volume. So, whenever we start looking at some of these, there's a significant overlap that we have to, account for. So, emerging markets remains a very good opportunity for us. We're looking at that. And if we find opportunities where we get, business plus capabilities, that would excite us a little bit more because then that gives us a platform for future growth as well.
Right. Actually, just one clarification, because your cash on balance sheet is pretty large now, and the kind of expansion organically and inorganic opportunity, it appears that, it won't get consumed. So, I mean, are we then thinking about high dividend payout? What are your thoughts on the cash that you have on your books now?
So, as I said, see, there are opportunities to deploy. We need to be selective. When we look at it as, in absolute rupee terms, it looks high, but if you were to chase 1 or 2 large transactions, meaningful transactions, this is not a very high amount of cash. So, I don't think, we are worried about the cash on our books. It gives us flexibility and it gives us opportunities to look at options which can help the future growth of the organization. At the same time, we do remain selective because, of the kind of opportunities that we are looking at, have to really pass all our filters in terms of, diligence and adding strategic value.
Right. Thanks and all the best. Thank you.
Thank you. The next question